Yields on Treasuries are currently higher than those on German bonds, primarily because interest rates are lower in Europe, where the economy is weaker. Rate cuts are intended to reduce borrowing costs for consumers and businesses. However, the increase in yields, evident from recent data, has made borrowing more expensive, which financial experts refer to as tightening financial conditions. In fact, the average 30-year mortgage rate rose to 6.9% last week. Treasury yields saw a significant increase in October following the release of strong monthly jobs data, which alleviated fears of an impending recession. The election of Donald Trump as president, who proposed policies that many investors perceive as inflationary, further influenced this shift. Additionally, Federal Reserve officials adjusted their forecasts, indicating fewer rate cuts expected in 2025. Despite the rise in Treasury yields, they tend to move in correlation with yields on German bonds. When Treasury yields rise, investors often sell their German bonds to invest in Treasuries for better returns, which in turn drives up German bond yields as well. On a positive note, increasing Treasury yields usually indicate a robust economy, which can support corporate profits. While inflation remains above the Federal Reserve's target of 2%, it has significantly decreased from its peak in 2022. Furthermore, the economic growth in the has been considerably stronger than in other wealthy nations. However, there are concerns regarding the reasons behind rising yields, including increasing uncertainty about the longer-term outlook for interest rates and inflation. Growing yields could exert pressure on stocks by raising borrowing costs throughout the economy and enhancing the risk-free return associated with holding treasuries until maturity. As this safer return becomes more attractive, riskier assets like stocks may appear less appealing. Despite positive economic indicators and Wall Street's initial favorable reaction to Trump's election, stocks have faced challenges over the past month. They could be particularly vulnerable to rising yields now, as they were already considered expensive by historical standards.